Good evening. We begin tonight with a seismic shock to the global economy. Oil prices have surged by a staggering 9% in a single day, the sharpest spike in over a year, as the simmering tensions between the United States, Israel, and Iran have erupted into open conflict. This is not a distant geopolitical skirmish. This is a direct assault on the world's most critical energy artery, with immediate and severe consequences for every nation, every business, and every household on the planet. I'm your anchor, and for the next 12 minutes, we will conduct a deep dive analysis into this crisis, the triggers, the immediate market panic, the global ripple effects, and the stark choices facing world leaders, including President Donald Trump and President William Ruto. The numbers tell a story of profound disruption. At the opening bell on Monday, March 2nd, West Texas Intermediate crude, the U.S. benchmark, rocketed to $72.79 per barrel. That's a leap of 8.6% from its closing price of $67 just days prior. The international standard, Brent crude, followed suit, soaring to $79.41 per barrel, breaching the $82 mark at its peak. This is the highest price we've seen in over 12 months. The catalyst was a series of precision strikes over the weekend, as U.S. and Israeli forces targeted Iranian military and nuclear infrastructure. Iran retaliated not with a ground invasion, but with a calculated economic counterpunch, a direct assault on shipping in the Strait of Hormuz. Let's visualize this initial shock to the system. The trigger was not just the exchange of missiles, but where those missiles landed. The Strait of Hormuz is a geographic pinch point, a narrow waterway between the Persian Gulf and the open ocean. But its significance is monumental. Every day, an estimated 21 million barrels of oil pass through this channel. That represents about 21% of global petroleum liquid consumption and nearly 30% of all seaborne traded oil. To put it bluntly, it is the world's most important oil transit choke point. A closure, or even a significant disruption, would trigger an economic catastrophe of unprecedented scale, and that is precisely what investors fear is now underway. The first tangible sign came with the attack on the oil tanker Skylight. Sailing under the flag of Palau, the vessel was struck near the strait. Its crew of 20 included 15 Indian nationals and 5 Iranian sailors. While initial reports indicate only minor damage and, thankfully, no fatalities among the 250 people estimated to be on various ships in the immediate area, the message was chillingly clear: commercial shipping is now a target. Insurance premiums for vessels transiting the Gulf have already skyrocketed by 300% overnight. Shipping companies are ordering captains to reroute, adding days and millions of dollars in cost to every journey. This is the hidden tax of conflict, paid by consumers worldwide. The immediate market reaction was a textbook example of panic buying. Traders, fearing a prolonged supply crunch, rushed to secure physical barrels and futures contracts. The 9% price jump we witnessed is not merely speculative, it reflects a genuine reassessment of global oil inventories. Analysts at Goldman Sachs have revised their quarterly forecast, warning that sustained disruption could push Brent to $95 per barrel by the end of Q2. But who feels this pain first and most acutely? For nations like India, this is not a distant discord. It is an existential threat to economic stability. India is the world's third largest oil importer and consumer. Over 80% of its crude needs are met by imports, and a significant portion of that flows directly from the Middle East through the Hormuz Strait. Every $10 increase in the price of a barrel of oil widens India's current account deficit by approximately $12.5 billion, increases inflation by about 30 basis points, and dents GDP growth. For a nation of 1.4 billion people, this is a direct hit to development and poverty alleviation programs. The Finance Ministry in New Delhi is reportedly convening an emergency session to discuss releasing strategic petroleum reserves and potential fuel subsidies, a fiscal burden it can ill afford. The ripple effects extend far beyond Asia. In Europe, still grappling with the aftermath of the Russia-Ukraine energy crisis, this new shock threatens to derail a fragile economic recovery. Natural gas prices, which had stabilized, are also climbing on fears that Qatari LNG exports could be impacted. In the United States, President Donald Trump faces a complex political equation. On one hand, higher oil prices benefit the powerful domestic shale industry, a key political constituency. On the other, they act as a tax on American consumers and businesses, fueling inflation just months before critical midterm elections. The White House has already announced it will consider tapping the Strategic Petroleum Reserve, a tool with over 600 million barrels in inventory, but one that provides only temporary relief. The calculus for President William Ruto in Kenya is equally fraught. Kenya imports all of its petroleum products. A sustained oil price shock directly translates to higher costs for transportation, electricity generation via diesel plants, and manufacturing. The Energy and Petroleum Regulatory Authority will face immense pressure to adjust fuel prices upward in the next review cycle, potentially triggering another wave of public discontent. The government's budget, already stretched, must now account for increased subsidy costs or risk social unrest. Economists at the Central Bank of Kenya estimate that a 10% sustained increase in oil prices could reduce Kenya's GDP growth by 0.5 percentage points this year. Let's examine the human cost beyond the markets. The conflict has already resulted in tragic loss of life. While the Skylight attack was a warning shot, other engagements have been deadlier. Reports from the region confirm at least 10 military and civilian deaths from the initial exchanges, a number that is sadly expected to rise. Over 250 personnel, from sailors to aircrew, are directly in harm's way. Families across Iran, Israel, and the United States are awaiting news with dread. This is the grim reality behind the financial charts. The strategic dilemma for global powers is immense. The United States and its allies, including Israel, possess overwhelming military superiority. They could, in theory, secure the Strait of Hormuz through a massive naval deployment. But such an action would be phenomenally risky, potentially drawing other regional actors like Saudi Arabia, the UAE, and even China into a broader conflagration. China, which sources a significant portion of its oil from Iran and the Gulf, has called for an immediate ceasefire and is likely using back-channel diplomacy to protect its energy interests. The path of diplomacy appears narrow. Iran has stated it will not negotiate under fire. The US and Israel have declared their objective is the permanent degradation of Iran's military capabilities. There is little common ground. This suggests the volatility in oil markets is not a temporary blip, but the new baseline. Traders are now pricing in a war premium that could range from $15 to $25 per barrel for the foreseeable future. Let's break down what that means for you, the viewer. If the war premium settles at $20 per barrel, the trickle-down effect is brutal. For the global airline industry, it adds billions in annual fuel costs, inevitably leading to higher ticket prices. For the trucking and logistics sector, it increases the cost of moving every single good, from food to electronics. For the average commuter, it means more money spent at the pump, leaving less for groceries, education, and healthcare. This is how a conflict thousands of miles away empties wallets on every continent. Are there any winners in this scenario? Some analysts point to oil-exporting nations not directly involved in the conflict. Countries like Nigeria, Angola, and even Canada see increased revenue from their exports. However, this windfall is often offset by the global economic slowdown that high oil prices induce, reducing demand for all commodities. The U.S. shale industry can ramp up production, but it faces constraints in labor, equipment, and investor pressure for capital discipline. It cannot fill a Hormuz-sized gap overnight. The most profound shift may be the accelerated push toward energy independence. This crisis is a stark advertisement for renewable energy and electric vehicles. Nations and corporations will now double down on investments in solar, wind, and green hydrogen to reduce their exposure to such geopolitical shocks. In the long term, this conflict may be remembered as the event that finally broke the world's addiction to fossil fuels. But in the short term, the pain is acute and universal. As we conclude, we are left with several critical questions. How long can the global economy withstand oil at $80, $90, or even $100 per barrel? Will the social contract in import-dependent nations like Kenya and India hold under the strain of soaring inflation? Can President Trump and other world leaders navigate a de-escalation, or are we locked into a prolonged period of energy-driven instability? The answers to these questions will define the economic landscape for 2026 and beyond. One thing is certain: the events of the past 48 hours have rewritten the rules. The era of cheap, stable energy is over. We are now in a new world, where the price of oil is dictated not just by supply and demand, but by the flight of missiles over the Gulf. The markets have spoken with a 9% scream. The world must now listen and prepare for the consequences. For Kenya News Update Today, I'm your anchor. Thank you for watching. Subscribe to Kenya News Update Today.